are in listen-only mode.
Good afternoon, everybody. Stan and Jack here, and we're doing a webinar on trading in volatile markets, trading in high volatility. We're going to talk about some techniques and tools that you can use, and we're going to also talk about things like reversion to the mean and explain that and how that typically is a setup or a precursor to volatility. And we'll also take any questions you have about trading in volatile markets or any other questions that you might have about that. So feel free to use the questions tab. And Jack, I'm sorry, our disclaimer, we do this for educational purposes. Our material we present here is intended to support you in your trading, and we're not here to issue trading signals of any kind. So that's the disclaimer. Jack, anything you want to add?
No, bang, let's go straight in. What do you want to start with?
Let's start with average true range. And
right.
I just wanted to point out, well, first of all, everybody is probably familiar with the VIX, and the VIX is a barometer of volatility. The VIX, however, is a fairly complicated formula that's used over a 30-day period to calculate, the actual level of the VIX. And there are VIXs for other instruments like Apple or oil or gold, and that's one way to look at volatility. But I think average true range is actually a truer measure of volatility. So. And I have average true range up here on the daily chart on the S&P 500. And what I want to say about this is I typically use an average true range of either 5 days or 3 days to really measure volatility. And I use this, and you can use this swing trading if you are a swing trader, for example, right now, and you're looking at a short. And I think it may be a bit early still for a big short, but I'm looking at a larger short up here in this yellow box when we get there, around 76 to 94. But bottom line is, if you're in a place where you believe that mean reversion to the mean, like reversion back to the monthly pivot, or reversion all the way back to the 200-day moving average, okay, if reversion to the mean, if you believe it's going to happen, well, you should be looking at average true range as a way of perhaps setting your stops. So, and the reason why this is valuable is, if you have a fixed habit of always using, for example, if you trade the E-mini and you use a 2-handle stop, or if you trade oil and you use a 20-tick stop, or a lot of folks, I hear this a lot, where people are using a 40-pip stop on currencies, okay? Those are sort of common stops, if you will. But, when volatility skyrockets and you're using the same stop system that you've used when the VIX was at 10 and now the VIX is at 30, well, you're going to get stopped out a lot, okay? So your stop system, if that's how you're managing risk, you're managing risk with a stop system, okay? Your stop system has to adapt to the volatility in the market. A way of doing that, of course, is with average true range. So average true range right now today is at 19. So I would say today, if I'm swing trading, I'm using a 6-handle stop. Now, do I put on a 6-handle stop if I don't see at least an 18-handle profit in the near future? Well, I don't. Okay, so you have to understand, I'm not putting on a trade and always using 6 handles. I'm waiting for the right setup, and I'm still waiting for the setup here to get short higher, okay? And we're not quite there yet in my book, but, when we get there, what kind of stop am I going to be using? Whatever stop I happen to have on my average true range, and that's kind of how I do it. Now, I want to take you back to here. You guys remember this limit down day that we had all the way down here into the it was down into the 1830s. I remember I got long at 1834 back here on the E-mini. Our average true range measurement was sky high. It was 70 that day. Okay, so if you were trading here and you were getting long, if I was getting long down at the bottom here, I'm using a 20-handle stop. Okay, versus today I'm using a 6-handle stop. And by the way, you can also do games like this with average true range. You can say, okay, are we ready for a reversion to the mean? Are we ready for a reversion to the mean? Well, let's see. We reverted to the mean probably somewhere around that line. I just drew a line on the chart. The line is around 11.9. And all I'm doing here is I'm saying 11.9 in terms of average true range seems to be a volatility level where we typically find a base. Okay, so here's a high, the A, okay? And by the way, one way of thinking about reversion to the mean is upper band, middle band, lower band. Okay, so here's the A. We're up near the upper band, right? Where we have a very, very low 11.9 reading on average true range. And what happened? Okay, volatility spiked. Okay, look at it here. Volatility spiked. Here it is again. Volatility spiked. It quieted down. Okay, we're in an impulse, etc. Here, volatility spiked again. Okay, so I'm waiting for volatility here to quiet down. For me, this is as much a measure of readiness for mean reversion as it is a way of monitoring your stop system, okay? So for me, when this quiets down, we get down into 11 or 12. The other good volatility instrument to use is Bollinger Bandwidth, which I'm going to talk about next after I get done with average true range, after Jack talks about mean reversion. But average true range is a very valuable tool to measure volatility. And it's a very valuable tool to understand your stop system. And usually what I do is either a 3 or a 5, and I usually use 1/3 of whatever the ATR is on a daily basis to use as a swing stop, okay? Now, the other thing that's important in terms of trading in a volatile market is, and the other thing I want to say about trading in a volatile market is this: volatility is a trader's friend. It is a trader's friend. Without volatility, I can't trade. I really can't. We had a day, when was it, Jack? It was just recently, where we broke through 2138, we back tested, and then the next day we went higher, but then the day was nothing. It was like sideways, and it went nowhere. It's like, you can't make money without volatility, and you have to really get comfortable or have a method or have a system that you can lean on when things get crazy. Like down here.
Actually, we've had a couple of those this week where basically all the action was overnight.
Yeah, right. So, those days I'm trading something else. I'm not even looking at the mini. But, here, for example, when we were down here, Jack, do you remember there were a lot of people saying, hey, I'm watching. I don't want to trade. I don't want to look at this. And what I want to say is that is wise. That is very wise if you don't have the experience trading in volatile markets. On this day, I made 90 handles in one trade, okay, only because I have a system for trading in volatility. It's not because I'm a great trader, guys. That's not the idea, okay? The idea here is if you have a system you can lean on, when things get when there's a lot of volatility, where there's a lot of emotion in the market, if you have a system you can lean on that works, you will make money. And that's the idea of this game, is for you to profit, okay? Without volatility, you're not going to profit. And you have to get comfortable using volatility to your advantage and understanding how to profit from it. So I think that's the main message I want to try to get across, and also using average true range. And we'll talk about a few other tools and techniques as well. So I think, Jack, that's my overview of ATR, which is a valuable volatility tool. I think you wanted to do something on mean reversion?
Yes.
Okay. Let me throw you the chart, and I'll get set up for Bollinger Bandwidth next.
Right. One thing to talk about is your principal mean reversion tool really is the Bollinger Bands. Well, at least the one that is most commonly used. You've got various time frames. This is showing it on the monthly chart, and when you are through the lower band or the upper band and you're running, etc., you are working your way generally to a significant high. When that ends, and obviously that can take a while, but this is the tech bubble here. It comes back to the middle band, then rides up, etc. But when it breaks through the middle band, it goes. Next bull market here, you've got the monthly middle band as support all the way up, and when it breaks through the middle band, it goes. It's now here, this bull market has been less certain. This was a technical bear market here. This hasn't been. This is the first time we've actually had a significant and sustained break below the monthly middle band on this, basically in the last 20 years, that hasn't actually resulted in a technical bear market. So it wasn't that far away though. And obviously, it was a nice setup. But the thing is, your first thing you need to look at is the Bollinger Bands. You're looking at the monthly, the weekly, the daily, for when it's very stretched. But obviously, you can also use it on the on any time frame to show when you are very short-term stretched. Use RSI as well. The divergence on there. Another tool which I use regularly, and if you're a regular reader of my posts, you'll have noticed this, is that I look at the volatility spikes. It's look at all these lows. Less so with the highs necessarily, because highs quite often, sputter to a halt, whereas lows tend to be hard and angry. But look at this. Look at this here. Volatility spike. That was the day before the low. Volatility spike. That was at the high. You don't always get the volatility spike, but here you've got another one. It's at a low. Rallies up to there. When you get down to here, volatility spike again. You've actually got a series of two of them. Second one nailed it. Third one, sorry, the first one was 2 days before. Again, we've got two here for 2 days before and at the low. This one here didn't deliver, and that's unusual. It just there was a little retrace, but it wasn't that far from the high. This one here, which was the last low of 1990, I pointed it out on the day before the low. It's again, if you're getting very stretched, you will often see something like this to mark when you're about to turn. Won't always deliver. Nothing always delivers, but it's well worth noting. Another thing to look at is, basically just talking about signals that we're about to see a reversion to the mean, because sooner or later, everything always reverts to the mean. When people say, oh, the bulls are dead now, or the bear's dead now, etc., that is never the case.
By the way, that's a signal that we're about to get a reversion to the mean. Seriously.
Yeah.
You see that on Twitter? I'm like, okay, it's time,
Yeah. When you're getting people say, in effect, that we're never going to revert to the mean again, it's generally a very good time to be looking out for a reversion to the mean move.
Yeah.
And that is because one thing I talk about, and I've talked about it in sort of our trading delusion section, is recency bias. It's a very human thing to look at what's been happening very recently and assume that's going to happen forever. And it's just obviously not the way it works. When there's been a big bull run, everyone's bullish. And that is when you get a rotation away from the smart money to the dumb money, and it's ready to revert to the mean again. It's I remember when we got down here, I was chatting to people on Twitter, and they were saying, oh well, it's going to go down hundreds of points. Definitely, there's no way it can bounce here, etc. And now, you've got people saying, the bears are totally dead. There's no way it can, go down. It's heading to 2,400. And the fact is, this is what people do. It's very human. As a trader, you have to actually train yourself to actually think past that. Because it might be a very natural and human thing to do, and it might be fine in lots of circumstances, but it's a disaster in trading to always buy at the high and sell at the low. You do not want to be doing that. What you need to be aiming for is exactly the opposite. So be aware of reversion to the mean. Here we've got one of the reversion to the mean tools I was talking about today was the band rides. When you've got a band ride, which we've got here at the moment, although we haven't quite hit it on the last 2 days, it's we've got a ride up the daily upper band. When that band ride ends, we're going to retrace. A lot of the time, we would retrace to the middle band. Sometimes we'd break through it and go straight to the lower band. You are looking at a mean reversion move when the momentum fails. Has the momentum failed? No, not yet, but it will do. Again, look at the trend lines. It's what you're trying to work out is when will the trend reverse, because sooner or later every single trend always reverses.
Yep, it sure does.
Yep.
Everybody gets their turn.
And if you ever find yourself thinking otherwise, then you're setting yourself up for a very nasty surprise.
Okay.
All right.
Okay, I have Bollinger Bandwidth teed up and ready when you are, Jack.
Yeah, that's wrong.
Okay.
Yep. Sorry about you, mate.
All right, thanks. All right, third tool. So the first tool, we talked about two different tools basically. Reversion to the mean, which is just a concept, right? And you can look at an upper band ride. When an upper band ride ends, or what happens, it reverts to the mean, which is often either a moving average like the 50-day, or maybe the 200-day, or maybe the middle Bollinger Band. It depends, okay? And there's also, again, what we talked about earlier, which was ATR, average true range, and using that as a way of managing your stops, but also looking at that as a way of actually being able to look at when expansions will occur, okay? Now, looking at Bollinger Band width, and what I use is Bollinger Band width on a daily basis at a 22 setting, okay? And sometimes I use 18.2 for different indicators, but this is a very nice tool to understand when volatility expansion is about to occur. So typically when volatility expansion occurs, you have your Bollinger Band width is very tight. So you can see I have a red line here, and the red line here is around 1.5. 1.5 does get hit, or 2 gets hit. This is a 2 here. It's not quite at 1.5. Here's a 1.5 here. This is actually below 1.5, which is a giveaway, okay? You see anything like this, it's a precursor to expansion, okay? So here is, like for example, this is a little expansion here, okay, which was a volatility expansion. Volatility expansion and Bollinger Band width tend to go together, okay? So here we are at 1.5, and we have an expansion. And typically, I like to manage my risk carefully. So, for me, I'm out of my trade, or most of it, around 5 or 6, okay? Sometimes the expansion continues, okay, and that's fine. But I'm looking to capture as much as I can by the time we're up around 5 or 6 on the bandwidth. Am I still in the trade? I probably still am if it's going higher, but it's a small size. So I think one of the things about volatility is managing your size. I think it's very important. So, our standard trading rules. Let me just show you this impulse here, which was, I remember trading this with you, Jack. We did a great job on this, except right here we got a little backwards, but we captured the majority of this swing. And the way we trade this, and this is just a standard sort of set of rules, and this is the set of rules I use. Use your own rules, okay? See that final swing right there, okay? If you're short up on top, you're out your first third early, okay? So your first third, you're out at 1998 from the high, which was at 2019, okay? So that's a nice 20 handle trade, right? You take off a third, you put your stop at even, and you let it run. Okay, you wait for a 3 down before you take off another third, and then you let your last third run. Okay, but what I'm doing here with that system is I'm waiting until, I'm not taking it all off until I get above 5. Okay, so that's one of the ways that I support myself in volatility to hold on to the trade, because let's face it, if you're a trader, you make money not trading by doing 50-day trades a day. You make money by holding on to your winners longer than you hold on to your losers. I mean, that's
it's actually really, it's tougher to hold on to a trade and stay in it than to find the decent entry.
Right. So find tools that help you do that, especially in the face of volatility, okay? So this is one of those tools. If I'm here and I'm at a 3 and I'm short, okay, and look at this bounce right here. Isn't this a bounce that would cause you to say, holy shit, I'm getting out of my short, right? Well, it bounced all the way back up here to the 50-day moving average, almost to the middle band, and it failed again, right? So, if you're in the face of this kind of incline, and let's take a look at this incline for a minute. So the low is 26. The high was 58. So, you just had a 30-handle face ripper right there in 2 days. If I'm here on my tool and I'm only at like 3, okay, I'm not letting that phase me. I'll take 30 in the face, and my stop maybe is at even up here, and that's fine because I haven't gotten the 5 yet. So you'll notice here how consistent this is. If you're down around 2 or 1.5, look at how consistent this is in terms of how often we hit 5. How often we hit 5. So this is one of those tools in the face of volatility. I find it useful because it helps me stay in a trade. And I think that's the point, because, if I can't hold on to my winners, then I'm not going to be making a lot of money in trading. That's fundamental to trading, in my opinion. So, so that's my thing on Bollinger Band width. Jack, what else do you have that you want to cover on volatility? I want to open up the floor to questions.
I just wanted to cover the there's a myth, I hear it quite often, not at the Art Chart, but at Twitter and various blogs or whatever, that when things get really volatile, all the normal TA rules stop working. And actually, to a certain extent, that actually is right. But only in a very
let me throw the screen back to you, because I think you might have a good example for us, because even this impulse that we've had, guys, it's played out to Fibonacci's perfectly. The first impulse, we stopped at 1.618, and we went to 2.618. We back-tested, and we stopped at, whatever. So the Fibonacci's still work, even in the face of volatility, in my opinion.
And the best example I've ever seen is this chart I've done on the 1987 crash and the bull market that led up to it. It's what are we looking at here? I mean, the main thing is, Obviously, this is one of the ultimate examples of very high volatility. But look at the structures here. You had a rising wedge, broke up, broadening megaphone, overthrew, came back down, gapped through megaphone support, and then kept on going really hard. Where did it come back to? It retraced 50%, pretty much exactly, of the bull market. It's a model Fibonacci retracement. It then did a double bottom with a marginal lower low, and then just crept up to the target gradually over the next couple of years. This was actually, in terms of the pattern structure and the Fibonacci's, this was a model of TA precision. And actually, you will often get that when you strip out the fact that everyone's yelling and shouting and it's all panic and the world is ending, etc. What you're just left with is the mathematical structure, and actually that looks just fine. And actually, another example that we're looking at the moment. Now, we don't know for sure that the low is in on bonds, but this is the TNX chart. This is the long-term 10-year Treasury yields. Now, what have we been watching here? Well, here, obviously, we're looking at this. This is the gargantuan bull market in bonds and bear market in yields over the last, since 1981. And we're looking at the end here, and we've been looking for this, and I think the turn's probably in, probably made the high last Friday, and looking basically for it to reverse back up here, which is a huge, huge moment. But what are we looking at here? This is, it's just a simple common or garden double bottom, marginal lower low there, and off to the races. And that's actually all it amounted to. I mean, we've done it in an awful lot more detail than that. But in terms of, if you were just looking at the ZB market and listening to the squawks, etc., it's all about the Bank of Japan, the Fed, and etc. It's this and that, and disaster, whatever. You've got to strip away all the bullshit and just see what's actually really happening. Because here you've got a major support test, and I think we're starting to see the rejection at that support test. It's probably going to be fairly violent. And it's going to have a huge impact over the next few years. But this is a bit like the yen thing. Everyone was talking about it, Brexit and the yen, and the Japanese central banks doing stuff, and this is, never think that the TA doesn't work. The yen's the perfect example. There's a post on the blog where you can hear me talking in a chart chat last August, predicting essentially the entire move and the ideal targets for it, which is where it hit. It hit 38.2% fib retracement of the falling wedge from 2012. And that is, the power of Fibonacci is very strong. What you do get, and where the extent to which this is right, i.e. TA stops working, is you will find, if you have a very strong trend, that you will start taking the lower probability options a lot. For instance, if you're in a very strong trend down and you have a falling wedge, it's more likely that the falling wedge will break down rather than up. Whereas normally, in a relatively two-way market, it would break up 70% of the time. It's that you will have. You will go through levels. You will have RSI divergences that don't deliver, and that's because a really, really strong trend will override everything. But on the bigger picture, because there always is a bigger picture, it'll still be observing the Fibonacci's and most of the other TA rules. Will still be recognizable trend lines and patterns, and because really what you're looking at is just moves which are killing a lot of these short-term rules, but they never kill the long-term ones. Right? That was what I wanted to say on that. I just wanted to show a couple of examples of where you get a lot of people running around like with headless chickens, like right here on bonds. Saying an awful lot of complete rubbish, talking heads, talking total garbage. But the thing is, actually, it's all relevant. Really, what we're doing here is we're just retesting this low. Well, we should find support there, and off we go. And that is the official end of the bear market deals.
And we're starting to see the fruits of our labor here the last few days on ZB, which is doing the inverse of what TNX is doing, of course, which is what it should be doing.
I mean, yes. But the thing is, the reason we've been spending so much time looking at bonds and talking about it in chart chat, etc., is because this is a huge turn. It's going to have a vast impact on the world economy over the next 10 years, because actually, to a certain extent, a lot of the economic policies which have become fashionable lately, like monetization of debt, huge debt levels, etc., they're all, to a certain extent, an artifact of very low interest rates because of this huge bull market in bonds and bear market in bond yields. When that reverses and it starts going up and people realize that central banks don't actually control interest rates, then we're going to see a reorganization. A lot a lot of countries are going to default on their debts. But anyway,
Yep.
it's this is you need to look past the rubbish and just see the bigger picture. The bigger picture is you just retested this low. This is on any pattern, any chart, any instrument. This is just a totally routine thing you often do at a turn.
Yep. Agree.
And it's just as boring and simple as that.
Yep.
All right.
I got one more item in terms of trading in volatile markets or trading in high volatility that I want to talk about, and that is, and this is more of an advanced topic. Okay, the wisdom of using stops. Okay, now what I want to say. Oh, okay, Jack, thank you. I'm not going to really use the screen at all this time for this, but I'll just show the screen just to talk through some things. You know, there's a style of trading. First of all, I love trading, and I love trading, period. Okay, it's not just about making money, it's the challenge. Okay, so, you know, I don't have to put a lot of money on a trade to actually be interested in it. So, you know, when there are periods of high volatility, very often what I do is I'm reducing my position size. And, you know, if you make a small mistake in high volatility, it can really cost you. So there's a lot of wisdom in trading without stops, but trading without stops with small size. Okay, so there are different, you know, there are different mechanics to, how can I say this, managing your account and managing risk. Okay, one, you know, well-tested and well-accepted mechanism is, of course, to use stops. Okay, and by the way, when I am long in this market that we're in right now, okay, I have an emergency stop on. So I'm not saying I never use stops, okay? One day we can wake up and Italy can announce that it's going to do a referendum to find out if its members want to be part of the EU. If that announcement happens, or if somebody just whispers that, okay, we can see the market absolutely turn on a dime and head south. Okay, that can happen. So this market, I just want to say this market is kind of dangerous. Okay, one piece of headline news like that from Europe and things can change rather dramatically. Okay, so you know, I have an emergency stop on anything long that I'm putting in this market at this point in time. But you know, if I'm in a volatile market and well, first of all, what I do is I reduce my position size dramatically. Okay, so you know, I'm usually if I'm trading, I'm using up to 20%, 30% of my account maximum for a trade, for any one trade. Okay, so I'm really shrinking my position size down to like 3 to 5% in a highly volatile market, and I'm doing that for one reason. Number one, it reduces my risk. Number two, I don't have to catch the perfect entry. Okay, with volatility, especially with the mini, okay, and you guys have seen it if you traded for a while. If volatility gets above 30, I mean, 2 to 5 handles is the noise level that you see. Okay, so you know, I can be very comfortable trading in a small size, and for me, 3 to 5% of my account is small size. I can trade that comfortably without a stop, and I'm okay. And by the way, you as a trader, you have to define what that is for you. But you know, I'm okay without a stop with a small size, and you have to define what that is for you. Now, if you have a very small account, I think it's a very dumb thing to do to trade without a stop. Okay, so if you have a larger account, you can manage size and manage risk through managing your size, the size of your trade. Now, what that means is I get to trade a lot more, meaning I may not make as much money as the next guy who has 20% on, but guess what? I don't care because I'm managing my risk, and managing risk comes first in trading, always. Okay, so volatility is number one, opportunity, but it's also risk that you really need to consider. So, and one of the reasons we're doing this webinar now is I believe we're about to enter a period of volatility. It's coming. We're not quite ready yet, but we're going to see some big volatility here between now and December. It's coming. So, you know, on our feed, what we do is when there's high volatility, we're recommending reducing size, and we're recommending emergency stops and things like that as well. So, I wanted to mention the size thing because a lot of people are not familiar with trading with small size without stops, and of course.
But actually, a very good example from the other day, and we were both doing it, Stan, was both of us taking a ZV short and going in small and just saying, actually, you know, we'll just wait.
Yeah, right.
and that is a very good example of that. We knew the top was close, and we were just prepared to be patient, and we just went in small, just to put our markers in at a reasonably good entry, which was likely to be fairly close. And I think we were talking about that at about 174 or something.
Yeah, right.
175. I mean, so it was. It wasn't that likely to go a huge amount higher, and we were just prepared to just sit through it.
Mm-hmm. Right. And I think the ideal entry, of course, is always the lower high, okay? And if you're going to do something in front of a lower high, it's usually a good idea to use a third of your normal size, whatever that is, and that's what we both did. And it's paying now for us big, So, okay, so with that said, Jack, I think we probably have time for questions. Do you have anything else you want to cover?
No, that's it.
Okay, cool. Let's see what questions we have. Folks, we have enough attendees in the room here in terms of questions. What questions would you like to ask about trading, risk management, trading and volatility, or anything else that might be on your mind? Just give people just a moment or two if they have a question or whatever.
Yep.
So we are doing another. While people are typing, let me just go to the website quickly. We are doing another webinar next weekend, I believe, Jack. Are we not?
This weekend coming.
I'm sorry, this week coming. I'm sorry, it's on the 28th of July.
I won't be there for that one because I'll be on holiday.
Right. So we're doing a chart chat. Those are the normal chart chats we do, but the next webinar we're doing is called Using Elliott Wave to Identify Potential Support and Resistance Areas, using fibs and patterns. So that'll be the next one on the 28th, and that's on a Thursday. So let's see if we have any questions. Let me look at the tab. We have no questions, Jack, so I think that's a wrap.
All right, that's a wrap.
All right. Oh, wait a minute. We have a question here at the last minute. Just in time, Sebastian. How do you know there will be a trend day the day before? Well, I don't know, Sebastian. What I have is a system, and you may or may not be familiar with program trading. So there's a world of trading out there where people invest based on the time of day, okay, based on the day of the week and based on the time of the day, okay, and there are computer algorithms that actually trade that way. It has absolutely nothing to do with price. It has to do with the time of the day, the time of the trading day, and a bunch of other variables. And you can, what I've developed is a system that basically says, okay, if program trading thinks like this, here are potential days that could be trendy, okay? And I was looking at possibly today and possibly tomorrow as possible trend days. Now, the other thing we do to confirm that is we look in the morning at 9:20 Central Time. Usually the first 20 minutes, first of all, the first 30 minutes of the trading day, program traders basically do nothing, okay? And I'm talking about not traders, but program traders, the guys who actually trade money using automated systems that base their trades on time only, okay? They wait until the market opens, they run their computer algorithms, and they typically start trading between 9 a.m. and 9:10 Central Time, okay? And usually those algorithms are fully engaged by 9:20 to 9:30, okay? So around 9:20 to 9:30, what I do is I look at the up and down volume on the E-mini. And I look at it and I say, so, how much up volume do I have right now versus down volume? So if I'm like in the 80+% range, over 80%, if I'm 90%, it's a very trend day and it's going. Okay, and usually when that happens, we say it on the feed. But if we're around 80% and we're like 300, the AD line's roughly at 300, positive 300 or negative 300, and of course the down volume could be 80 or 90%. Those are potential trend days around 80. Anything less than 80%, both sides have a chance. Okay, so there's the opportunity in the morning for program traders to jump in the market and just bury the needle, and basically if you're trying to go short on a trend up day, I mean, you're screwed. Okay, so it's good information to know, of course, in terms of trend days. So that's kind of how I do it. And the day before stuff.
There are various other things as well as confirmations.
Yeah, sure.
I mean, trend days are complex, and I mean, when I'm calling a trend day on the Twitter feed, there's generally, I mean, there's quite a few things I'm looking at. I'm looking at volume, I'm looking at RSI levels, So, I mean, you're looking at a series of indicators to basically see if there's a way that this is going to turn around. Are you looking at two-way trading, or are you looking at unidirectional trading?
Yep. And basically, when I say on the feed it's a two-way day, usually at 9:30 is when I'm saying that, or around that time. It might be a little early or a little later, but if it's a two-way day, it's a different trading day if you're day trading. And if you're a swing trader, it's a different world. But the days where we have back-to-back trading days, we're usually good to get one solid trend day when we have back-to-back trend days on cycles. Okay, next question is from Jorgen. I wonder what provider for charts you are using. Are you talking to Jack or to me? What I use is Trade Navigator. You can see it up here. I don't have the fancy stuff. I have the basic standard edition Trade Navigator. It's their data feed. By the way, they have a great data feed. This package allows me to manipulate futures data, unlike any other package out there except for one other one. CQG is the only other one that would allow me to manipulate futures data the way I want to manipulate it, so I can use it for longer term reasons and even out stops and stuff like that. This package allows me to do that. And CQG allows me to do that, but I am not going to pay as much money as people would pay for CQG. It's the Cadillac. This is more like the Volkswagen. I like driving a Volkswagen myself, so that's kind of my charting system. What chart system do you use, Jack?
Well, on the futures, all the charts you see me post are from, well, practically all of them, from Interactive Brokers. It's just their standard package. And on the RTH charts, they're all stock charts.
Yep.
The stock charts is a paid package. Paid quite a lot is that you get quite a, I think it's about 1,000 a year or something. But for that I get an awful lot of data. My long-term charts, go back 50 years, etc. It's important. I mean, if you're looking at bonds, for instance, if you're only looking at the last 10 years, you're not even vaguely close to getting the big picture.
Yep. Next question, Sebastian. What systems do you use for time? Hearst cycles or something similar? I use 3 different systems for time, and time is a bit of a crapshoot when it comes to trading. Okay, so Hearst cycles are fairly reliable. There are different packages that allow you to use those, but they're not 100%. And by the way, nothing in trading is 100%. There are certain setups with Hearst that work extremely well, okay? So, I use that, and that gives me insight. I also use cycle brackets, which I'm sure you're familiar with, where, and by the way, certain instruments with cycle brackets really work well. Currencies, longer term with cycle brackets, work extremely well. So cycle brackets are another tool. I don't use Fibonacci's. A lot of people use Fibonacci's. I don't find that is as consistent as cycle brackets or as consistent as Hearst. And there's a last one I'll use, which is a pitchfork technique. Let me get out my pitchfork tool here and share this with you. So this is a pitchfork technique I use. I'll draw a pitchfork like that. Okay, you can see the pitchfork, I assume. I'll make this a little bigger just so you can see it. Let me make this thick. Okay, there's the pitchfork. And what I'll do is I'll use what I call the box method. It's very simple. It's a very, very simple trading technique where you use this for time. So you can see from the origin of the lower part of the pitchfork to the high, that's a time period, right? And what I do is I drag this over, and what this shows me is the extent to which that downside action could occur inside the pitchfork before we get a turn to break out of the pitchfork. So you can see that this is relatively close. I mean, we came within a bar of this B here. It wasn't as narrow. And by the way, I could probably, let me do it this way. Let me just move this one aside and do it again. I bet money. And by the way, with this technique, you can do things like this. You can say, well, let me go to this high instead and see where that takes me. Or you can say, let me go to this high instead, see where that one takes me. And they work, okay? They work. So, let's see what this one does. I haven't done this, so I don't know where it goes. But, I tend to use this for the larger measurements. Sometimes it's spooky how well this works sometimes with certain instruments where you can look at this high and it correlates with this low, You look at this high, it correlates with this low. It's kind of spooky. So this is another tool I use, and it works, and I like it. And so those are the three that I use. Jack, you have any
Yep.
comments to add around time?
In all honesty, I don't actually do an awful lot with time. I'm never really that interested on when it's going to happen. I just rely on Stan for that. The only time I will really comment on it is if I've got a confluence of two trend lines which are meeting at a particular place, and you quite often find you get a touch then. Then I will talk about a time. Because if it meets at because then you have an exact date or a couple of days where the ideal hit would occur. But
Yep.
otherwise, generally, it's never really a factor.
Yep, that's a good tool to use. Let's talk about. Let's see. You mentioned that you expect volatility to increase in the second half of the year. Why is that, Jack? What do you think?
Well, I think actually, in terms of when you need to remember that actually we're talking about it relative to the volatility now. Rather than the volatility over the year to date so far.
Yes.
We've actually had quite a lot of volatility so far this year. I think we're probably going to have quite a lot of volatility for the rest of the year. I think we're at a bit of a lull right now because we're on a sort of a thrust up. I don't think that's likely to be the case for most of the rest of the year.
I agree.
This is not 2013.
Clearly not. And by the way, 2013, we had 52-week highs where we had 500 new 52-week highs, 600, even a couple of days we had like 700. So, we're down around, yesterday was 312, I think, new 52-week highs. So this is not let's put it this way, price is going higher, okay, but this is not an impressive bull market, okay. We don't have a lot of expansion going on, okay, in my opinion. So I just want to mention that.
Yep.
Okay, in terms of when do you expect the high window in SPX? I'm expecting a turn, roughly speaking. I'm looking at my chart now, my cycle chart. But I'm looking at towards the end of this month, okay? Towards the end of this month, I'm looking at a turn in the S&P. That's the short-term window, okay? I'm looking at fairly significant lows at the end of the year, around November, December, and that's one of the reasons why I think we're going to see an increase in volatility. I'm not calling for a new low. I'm saying there's a time cycle that says that we have a potential low sometime at the beginning of December, end of November, okay? So.
Now, I think we're probably going to enter a topping process fairly soon. I think people usually underestimate how long that takes. A topping process for a move like the one we've seen from the February low can take a couple of months easily. For a really big move, for a bull market, etc., a topping process can take a couple of years. And actually, for bond markets, this current low has been forming for, I think, thick end of 10. So, I mean, the thing is, on a big move, you will get a topping process. I think we're probably about to enter the topping process for this move, and that's probably going to take a month or two.
Yep.
When you're at a low, you often get a spike back upwards, and the lower prices are distant memory fairly shortly afterwards. That doesn't tend to be the case at a high.
Yep, that's right. And I just want to say that my center date. I'm looking at a window here where the center date is roughly the 27th of July. Okay, that's the center date. So that tells me then, by the way, the next low window then has a date basically in August, in the third week of August, roughly speaking. So the center date for the next low window is around the 20th of August. Okay, now that is not a major low window. That is a minor low window, which then will call for of course, a bounce, perhaps a higher high or perhaps a lower high. On a cycle chart, you can't tell.
That would often be the low before the high,
yeah,
as we would call it.
Yep, right. And so the major low, which is really the breakout low, doesn't really occur until November on my stuff. Late November. So that's kind of where I am at on cycle charts. So, Sebastian, I don't understand your question. You're saying something about 2170 and 2190 and the final leg of the bull market. I'm not sure I understand what that means.
He's talking about if the move down to 1810 was wave 4 of the bull market from 2009, and we are now in wave 5.
Yeah.
I think he's asking how far wave 5 is likely to go.
Well, I have to tell you, I don't spend a lot of time thinking about that, but if I do a very, very basic wave 5 analysis, and this is the extent of my analysis, we have the possibility of seeing 2290. That's the possibility. The other possibility is stopping in this area at 2176 to 2191. Okay. Now, wave 5s are notorious in this market. Well, in history, let me just say this. Third waves are always the big expansion wave. We've seen that. Okay. And we saw the contracting ending diagonal to end that. Okay. So here's the fourth wave. We have basically this W, this X, and this is going to turn into either a 5-wave structure, in which case we're done, or this is going to actually exceed 91s. If we exceed 91s and end up here somewhere and then backtest, we will definitely see 90s. So this could be a 3-wave structure, which is how I typically look at the market, or this could be a 5-wave structure, okay? And if it's a 5-wave structure, we're going much higher. I'm currently looking at a shorter target at this moment in time, and by the way, the short target here is 2207. But I'm looking at this market day to day. I'm not making any big bets long. I don't believe that this bull market is going to last forever. I think end of July we're going to see a mean reversion move, or towards the end of July. Between the 21st and the end of the month, we're going to see a mean reversion move of some sort, and then potentially another high. Okay, then potentially another new high. That's what the cycle charts are telling me, but I'm not going to decide that until I see this high and then see the back test to decide. I want to see what happens at the monthly pivot. Monthly pivot is an excellent mean reversion target, which right now sits at 2070. We'll see what happens. Does that mean the impulse up will go until the end of July? No, it doesn't. It means we'll have a pullback of some sort between, say, the 21st and the end of the month. Somewhere in that window, we're going to get mean reversion, and we'll see how it goes. So I think we have another week of uptrend, in my opinion. We may have some minor pullbacks, but I still think we have more upside to go, in my opinion.
Yeah, the trend line's unlikely to last throughout that period. I mean, because it's just too big. But the thing is, just because the trend line breaks doesn't mean that the uptrend is over.
Yep.
It means you're in the topping process.
Yep. I agree with that.
Yeah. It'll go higher.
Yep. Okay, Jack, I think we're out of questions. By the way, folks, great questions as always. I really appreciate them. And thank you for attending. And Jack, thank you as always.
Oh, pleasure as always, mate.
Yep, same here, Jack. Take care. Bye-bye.
Take care.